All right, welcome. The newest edition of the Real Estate Rundown. It's October 2024, and I have some exciting market stats to share with you today. So we're going to be talking about some recent news. The biggest question we've been getting lately has been, well, are mortgage rates going up or are they going down? And that's not an easy question to answer. So we'll look at some charts and some stats and some reasons why the market's reacting the way that it is. So um, another big question that we're getting from a lot of customers is, should we buy now or should we wait until later? And that's not an easy question to answer either. But I have my opinion, and we'll talk about that. And then a lot of customers have been thinking, well, hey, the rates are coming down. Maybe I should be refinancing. And so we'll look at how to run the numbers, how to figure out if it's worth it to refinance or not. So first off, one of the coolest headlines that I've seen lately is that homeowner equity is up $1.3 trillion in the last year. To the average person that owns a home, that's about $25,000 that your home has probably gone up in the last year. I mean, of course, that varies from area to area, but 25,000 in equity over the last year is pretty good. So the question that we get a lot from that is, well, how do I access it? If I want to access my home equity, what kind of options do I have? And there's lots of different ways to do it. You can refinance, but a lot of people, if you have had your house for a while, you might have a super low rate on your house, on your current mortgage, and you don't want to refinance out of it. So then we look at second mortgage options where you keep your house, where you keep your current mortgage in place, and then you just take out a second loan. Those come with some pluses and minuses. The plus is you don't have to lose out on your low rate, but the negative is that you tend to pay a higher interest rate for these loans. The home equity, and I wrote down here HELOC and HELoan. So the HELOC is a line of credit, so it tends to be a variable rate. They're usually tied to the prime rate, which right now is 8%. And so you're not going to see much lower than 8% on a home equity line of credit. And then the fixed rate loans tend to be about the same, maybe a little bit higher, but you can access up to 80 or 90% of the value of your house using these. So you take whatever your home's current value is times 90% minus however much you owe on your first mortgage, and that's about how much you'll get out on a home equity loan or line of credit. If you want to access 100% of the equity, unless you have VA eligibility, you can do a VA loan up to 100%, but otherwise you'd have to sell the house to get access to all of your equity. A lot of people don't want to do that. Buying something else might be more expensive right now, or maybe you like your house just fine and you want to stay there. So for another option that a lot of people don't consider is if you're 62 and older and you have a lot of equity in your house, a reverse mortgage is a great way to access it without having to add a monthly payment. So reverse is something else to consider. And then Nova came out with a new product recently that lets us help to give you access to your home equity in a very short period of time. It takes about 5 minutes to get approved, and you can get your money in 5 days or less. So if anybody's interested in just looking at it, it's kind of an AI-driven tool where it does an automated valuation on your house. It does a soft pull on your credit, so it doesn't hurt anything to give it a shot and just see how much it'll approve you for. They're all across the board. I've seen rates in the 13% range and people getting access to 30 or 40,000. And we just had one yesterday that's approved in under 8% interest rate if he takes the best terms, and up to 200,000 on that one. So it's all across the board. If you're interested in accessing your home equity, then reach out and we can check it out for you really quickly. Now, mortgage rates have been ticking upwards. So everybody has heard the news where the Fed cut interest rates by 0.5%. So everybody calls and says, hey, I heard rates are 0.5% lower. So I just want to show you a little bit of, this is this year of rates. If you look at this chart here, the blue line is what mortgage rates have been doing since about May of this year. Now you can see they've kind of been steadily coming down. I drew this trend line. This red line here is where you could see that rates were coming down. Now, right here is September 17th when the Fed cut the rates by 0.5%, and look what happened to mortgage rates after that. They've been steadily going up, and more than steadily going up over the last few days. So why would that happen? So the first answer is that while the Fed only meets every month or two and they try to affect monetary policy, the bond market and the stock market are open every day, and they trade up and down every day based on what the news is saying and based on what's going on in the economy. So since the Fed had previously forecasted that they were going to be lowering interest rates, the market already kind of priced that in. We factored it in. We knew rates were going to start getting cut. And so you saw the market responding to that all the way back from May. So for the last several months, we've had rates improving and getting lower. I mean, you can kind of see on this chart, went from about 7.5% all the way down to a little bit over 6 in the low sixes. And so that's what about a 1.5% increase or improvement in mortgage rates before they cut rates, and now it's gone up another quarter or 0.3% since then. So there you go. Now we ran some numbers on, okay, what does that actually mean? What do lower rates mean? So if you were buying a house for say 450,000 6 months ago, you probably would have been paying about a 7.25% interest rate. Well, on an FHA loan, that's going to give you a monthly payment of $36.23 for that $450,000 house. Now, fast forward to today, or maybe a week ago or so ago, and the rate would be more like 5.75, which is $436 less monthly payment. So those rates make a big deal. You buy the same exact house for the same price, and your payment's $436 lower because of the improvement in the rates. Now, the other way you could look at it also is buying power, which I know nobody really thinks about buying power, but say 450 was the most you could qualify for, but you didn't like the house and you wanted something a little more expensive. Well, when rates come down, now you can qualify for the same monthly payment for a higher sales price house. So if you were good with this 3623 and that was only getting you 450 6 months ago, now it might be getting you closer to 512,000. That's an increase of $62,000 in how much you could buy with that same monthly payment. So I think that's pretty cool. Now, since this 5.7 now, with the rates ticking up a little bit, it's not that the 5.75 rate is not available. It's just costing a little bit more in discount points. So the rate is still there. Might just cost you a little more. Now, here's another inside look. I thought this was an interesting view. Now, this is the mortgage bond market, so it works in the opposite of rates. So as the bond market goes up, that's good for rates, which means it's lower. So you can see we have this 3.5-month rally. This is exactly the opposite of the mortgage rate chart where it's going up, getting better. And there was actually a 6-day window there where we were able to lock some people in at some super low rates. And then the market turned. Once they cut rates, pretty much the next day, you see this drop where the market got worse, and then it's kind of just gotten worse and worse and worse since then. And then today is actually right about the same at the bottom of this trend. So anyway, these little windows of opportunity come and go really quickly. So we try our best to reach out to our customers who are either floating their interest rate or considering refinancing. And we try to reach out and get you set up so that we can make a move on these rates super quickly. I think the average person is not watching this every day. Like Paula and I are just sitting here with this open up on one of our screens throughout the day, and we watch this very closely. You wouldn't necessarily know those 6 days until now. Actually, we didn't even think about it being 6 days until a few days ago when we looked back. So I think when you look back in the rearview mirror, it's really easy to see those little windows of opportunity when they come, and it's like, well, hey, rates have been getting better for 3 months. Maybe they'll continue to get better. And it's really tempting to say, well, maybe we should wait. And sometimes by waiting, you miss out on good opportunities. So you might qualify for more if your payment was going to, okay, we already talked about that. Now, refinancing. Let's talk about refinancing for just a minute. Our team offers a program called the Rate Redo Refinance. So what we can do is offer to refinance you with no lender fees, no out-of-pocket expenses, and give you the same term on your loan. Meaning if you bought your house 2 years ago with a 30-year mortgage, now you have 28 years left on it. And so you take a 28-year term instead of a 30. That's an option that we do. Now, when you're factoring whether or not it's worth it to refinance, you have to look at what's the cost of the refi. Now, if you're doing the rate redo refi, then the cost is very minimal. It's really low. And so it ends up paying off really quickly. So let me just show you an example here of one customer where the house is worth 352. They owe about 243,000 left on their loan, and they're at 7.25%. Now, when we quoted this option, we could do the rate redo refinance at a rate of 6.75. So that's a 0.5% savings off their current rate. And notice that the loan amount stays exactly the same. They had to come in with about $1,500, which was just their escrow account of putting in the money for taxes and insurance. What happens when you refinance is they refund those to you, but not till after closing. So we roll them into the mortgage usually, but in order to not add anything to the loan amount, we keep it at the same exact loan amount, so you're not adding anything. And we do a 29-year term. This person had only been in it for 1 year. So they had 29.17 years to go on their current loan. We do the new one at 29 even, and then their payment drops by $78 a month. So you might look at that and say, well, it's only 0.5%. It's only $78 a month, but really it's $78 a month savings forever for free. So you might consider jumping on that. A lot of times our customers will say, well, that's maybe not enough to make it worthwhile. And so we can show them the other options depending on what the market is doing. And so a low rate refi would be, hey, we could actually drop your rate as low as 5.5%, which saves you $253 a month. Just keep in mind that now we're increasing your loan amount. Instead of owing $243, you're going to owe $250. On these type of deals, we would probably just do a 30-year term in order to get your payment as low as possible. You just take the 30-year term. I mean, 1 extra year on the loan is probably not too big of a difference, and it gives you more monthly savings. So that way you'd save $253. But when you're figuring, okay, how long is it going to take for me to break even? If I'm adding $7,000 to my loan amount and an extra year onto the term, yes, I'm saving $253, but how long until that pays for itself? And so we have a software where we calculate something called the total cost analysis. And this takes into account the additional terms that we're adding to the loan, the additional loan balance that you're taking on because of the added cost of the refinance, any money that you're coming out of pocket with, and then factors in the interest and the monthly payment savings and the additional amortization. So that total cost analysis is just a calculation that takes all those things into account, and then it spits out a number that says, okay, over 24 months, so if you were to keep this loan for 2 years, then the rate redo refi saves you $2,443. You'll come out that much ahead by doing the refinance. If you go with the low rate refi, it's $2,898, and then shorten the term, which we looked at doing a 20-year term instead of a 30. That was the other option. And you come out ahead there, but your monthly payment goes up. So that's one calculation to look at. And then the other one is how much you're going to save in interest over time. So, mortgage tends to be 15 to 30-year term. And so we have to look at the long term. If you were to keep the loan for 15 years, then obviously the shorter term at the lowest possible rate is going to have you paying the least amount of interest. So does that make sense? Any questions about that? Paula, any thoughts? No, covered it? Okay. All right, so there's lots of different things to consider when you refinance. I tend to like the rate redo option, or at least the no closing cost option, because you can rewrite your loan every 6 months. We can lock it in after 4 months and close it at the end of 6 months. So once you've made 6 monthly payments on a loan, you're eligible to refinance again, and then we can just rewrite it again. So if you're paying a whole bunch of closing costs and adding money to your loan balance every time you refi, then you're going to hesitate to take advantage of those little market moves when they happen. But if it's not costing you anything, you get to skip a monthly payment and you get to take advantage of a lower interest rate without adding to your loan balance, then there's no reason to hesitate to do it in those kind of cases. So, right, there's different reasons to refinance. It's not always just a lower interest rate or payment. Sometimes you want to shorten the term. We have a customer right now that's wanting to do a 15-year and put a bunch of money in just to get on track to pay it off as soon as possible. Getting cash out, which we talked about, the home equity loans, removing an ex-spouse or a cosigner, freeing up FHA or VA entitlement. There's lots of different reasons why you might refinance besides just the rate. So, all right, I want to talk about a little bit of Yuma market and what's going on in our local market here. This is listings versus sales, and you might, if you listen to real estate news at all, you probably hear talk of inventory mounting. So inventory meaning house gets put on the market, it doesn't sell, it sits there for a while, that becomes housing inventory. So on this chart, all of these orange bars are new listings added to the market each month. And then the blue is how many homes sold that month. So last month in September, 325 new listings were added to our market and only 159 sold. So obviously you have what, 175 or so new listings sitting there that haven't sold yet and adding to the inventory. So I think there's 600 and something homes available in the Yuma market, which is a higher number than we've seen for quite a while. And you can see the orange is taller than the blue every month, almost every month on this chart. That means the inventory is growing, so that's pretty good. I think as soon as rates come down a little bit more, we're going to see more people coming off the sidelines and coming into the market, which that inventory is going to be very needed at that time. The other thing to look at is average sales price, which this is percentage change year over year. So if you look at September, we're up 12.8% from this time last year. Of course, you go back to September of last year and it was very flat at 0%. And then September of the year before that, it was higher. But still, if you take a 2-year average of that, that's a 6% appreciation over the last 2 years. The other interesting way to look at it is year by year. So this line here at the top is 2024, and you can see that our average price has been higher than previous years every single month this year. So home prices continue to go up, not by much, but by a little bit at least. And then this is number of sales per month, which the shorter line here, that's 2024. You can see it's at the bottom. So we're selling fewer homes, but our average price is continuing to go up. Now, I went back just month by month for the last 7 years, so back to 2018, and I thought this was a very interesting way of looking at the market. And this is units sold month by month, all the way back on the left, you have January of 2018, and you can see the last couple of years, two interesting things about this chart, I think. The one is the ups and downs. So you have these seasonal moves where it tends to be slow around September, November, December, January. We just sell fewer homes all the time. And then just the last 2 years in a row, you could see it's down a little bit from previous years. We're averaging less than 150 sales a month, which is kind of interesting. And then the average sales price. Now this one, if you think about, okay, is the market going to crash? Are home prices skyrocketing? Well, I think this gives you a very clear view of the answers to those questions. So back in January of 2018, the average sales price in Yuma was about 180,000. Now our average sales price is what, 330 something, or no, 290 or so. This is just single family homes, but it's just under 300,000. So if you go from the bottom down here up to this little peak that happened, I think it was July of 2022, that's up 47% in those 4 years. That's a pretty big move. And then there's a few different ways you could calculate the last couple of years. I went from this little guy down here to last month, and that's about 11%. So that's 5.5% a year of home prices going up. I mean, it looks pretty flat over the last couple of years, but still ups and downs. I mean, if you went from this peak here to this one here, then it's very flat. It's almost zero. But if you went from here to the peak that happened in, what month was that? June or July? Then that's an 11% too. So I think 11% is a pretty conservative number for the last couple of years. Now, the forecast appreciation rate for Yuma, and we subscribe to a service that gives us access to this. So they think homes are going to go up at 3.47%. So it's a little bit slower, but if you just forecast that out, a house you buy for 300,000 today, 2 years from now is going to be worth 321. 5 years from now will be worth 355. So if it goes up at 3.5%, then you're going to end up paying more for a house in the future than you would today. So just running the numbers. So I've been wondering this, and you hear realtors say it all the time, but you don't know if it's a sales pitch or if it's actual numbers. So I just thought I would run these numbers and say, okay, a year ago, I mean, last October, rates were close to 8%. So if you had bought a house at 300,000 and put 20% down at 8%, you'd be paying $1,761 per month. Okay, now the same thing today at about 6.25 is about the average rate. It'd be $1,478. So if you were to hold off, or say you bought the house today for 300, and then a year or two from now, you go and just refinance it when rates drop to 5%, then it'll be $1,288. Okay, so there's a little scenario for you. You waited, you didn't buy before, rates have come down, you buy today, and then you refinance in the future. You'll end up with the long term, if you're able to get a 5% rate. I'm just making these numbers up. This isn't reality, but just say it happens, then you would drop your payment to $1,288. Say you don't buy today and you wait until the rates drop to 5%. Well, according to these numbers, say that's 2 years from now, you're going to end up paying $321 for the house that today is $300,000. So we throw that over here on the right. You buy the house for you buy the house for $321. Now you end up having to put $4,200 extra down payment to make up the difference of that 20%. But you get your 5% rate. Your payment's going to be $1,379. So you actually do end up paying more monthly than if you had bought today at $300, refinance when rates drop to 5%. What do you think, Paul? Is that good math, or am I missing something?
Yeah, that sounds about right.
Yeah, I don't know. I mean, it's not much difference, but it's a difference. And look at this, you're going to owe what, 16,000 more on the house too. So
Yeah.
I don't know. I think it makes more sense to buy today as long as you can afford the 1478. I mean, you don't want to get into a payment that's too high and you struggle to make it. But if you can afford the 1478 for now, that's going to be the highest your payment's likely going to ever be, because at some point there will be an opportunity to refinance to a lower interest rate and you're going to end up saving money. Okay, a couple other market stats that I thought were kind of fascinating. You would think, okay, inventory is building, homes are sitting on the market longer, so it must be taking longer for homes to sell. So this DOM is days on market, which counts from the day you listed your house for sale to the day it closes into the new buyer's name. Well, you could see it's been going up for the last couple of years. The days on market average has been increasing, but not by that much, and it's still lower than it was in 2018. So, I mean, the average is like 80 days right now, less than 3 months. So I don't think that's terrible. Now, if you saw homes sitting on the market for 4, 5, 6 months, then that would be a different story. Other interesting stats. So percentage of sales with price reductions. Now, this fluctuates. You could see after COVID, there was not many homes for sale. Rates were super low. People were coming out of the woodwork to buy houses. Things were selling for more than asking price, and almost nobody had to reduce their price. It says 10%. I mean, you can see it's right around 10% back during those years. That's probably just because people would come and say, wow, my house is worth 250. I'm just going to ask 300. Somebody might pay it, and they might, but then they might end up eventually having to reduce the price in order to get it sold, but only 10%. Now, right now, we're sitting at about 30%, maybe 34% last month of homes with price reductions before they get them sold. So that number is increasing. Now, this list of sold ratio is what I was just talking about. If you look at this 100, that means that during these months where it's over 100, homes were selling for more than asking price on average, which is just wild. I don't think we've seen that ever since I've been tracking the numbers. Now, right now, we're sitting right at about 99%. So about a third of homes have to get their price reduced before they sell. But once they arrive at the right price, then they sell for really close to asking price, 99%. Now, the other thing that those two figures don't factor in is seller concessions. So how about percentage of sales with seller concessions? Now, again, after COVID and stuff, you had the housing market was crazy. There were not that many people getting seller concessions. This shows at its low, it was what, like 20% or so? Well, it didn't even seem like that. I remember a time where we just weren't seeing any deals where the seller was agreeing to pay any kind of concessions to help out the buyer. Right now, it's 50%. So you have a really good shot if you're buying a house now of getting the seller to help cover your closing costs, which makes a big difference. Let me show you what difference it makes. So if you bought a house for $350 and the seller covered closing costs and you got an FHA loan, then you'd need about $12,000. $12,250 is my estimate. You could get a 5.75 rate. There's a little bit of discount points there with the seller covering them. Your payment comes out to $2,477. Now, if you were to buy the same house without getting any help from the seller, you're going to need $18,278. So it's about $6,000 of closing costs. So you end up needing, instead of $12,000, you need $18,000. You probably, in order to keep those costs low, we're going to do a little bit higher rate to not pay discount points. So your monthly payment ends up being $110 more. and you need $6,000 more out of pocket to make it happen. So there is a real benefit as a buyer to getting seller concessions. So when you're in a market like right now where you have 50% of sellers are agreeing to pay concessions, then that can really make a big difference on your home buying. Did I forget anything else? I guess that's really it. You could see that as the market fluctuates, there's times where the sellers are less willing to agree to do things. They're less willing to cut their prices. And so right now is kind of a window of opportunity in the market where mortgage rates are a lot lower than they were. Your monthly payment's a lot lower than it would have been. And you can probably end up getting a good deal on a house and getting a lower monthly payment than you would have had to. And then if rates drop again, we rewrite your loan, refinance you to a lower monthly payment, and you're good to go. So thanks for coming. You have anything else to add, Paula?
No, I don't.
Okay. All right. Thanks for coming, and we'll see you again next time.
All right, bye.